first, from a leadership standpoint, that really stands out to me that I focus on with our people is what we call the why. And this has become more and more popular, this thought about why. And some of you may have read Simon Sinek's work. He's published a few books about, the why. And his focus on why is really understanding and being able to articulate to your customers, in the case of a company, why you exist, and uses a good example of Apple. And it's not about what they do, it's, why they exist. And the whole point is to create a connection, a feeling for your customers, in that case, to have an emotional connection with you, a connection at a deeper level beyond, what it is you do or what product you provide. And so when you think about it, though, in our business, the business of banking, it's pretty difficult to do that. It's really it's a branding exercise, and we think about it, how we connect with our communities. But I think the thing from a leadership standpoint that I and we have translated is, as you think about inside your company, your organization, with your teams, think about the why. Because we're really trying to accomplish the same thing with our teams, and that is that emotional connection that leaders want to establish, because that's that connection, that understanding of why we exist, that understanding of why does my department do what it does in pursuit of a corporate strategy. When you get into bigger companies, many times there's a complete disconnect between, here's our corporate strategy and my department, what's our role in that? And it's understanding that why that helps grow that next generation of leaders. And, so one of the things I think about is over the years, and I'm sure many of you have crossed this bridge where you get frustrated, you've delegated some kind of decision making or some kind of project, and what comes back to you, think, oh my gosh, do these, whoever was working on it, did they get it? That was kind of a dumb decision. That's not what I would have done. And I think many times it's because, we as leaders didn't do a good enough job of articulating that why, not what to do, but why we do it. And if people understand the strategy and understand the why, I tend to find, and we tend to find in our company, that we all march much more to the same drum. So just understanding and articulating, why we are doing what we're doing, and really going out of your way to do that, I think, makes a big. Leading from the heart just means, that you really do authentically care about people, and you care, and maybe a better way to put it is you're passionate about what you do, because people can read you. Everybody can read you. People aren't stupid. Sometimes we think we can fake it. We can't, know that they do. And those that try to do this lead from the heart, or, try to practice humility, but just do it on the surface. Again, people can read that. In my world, in a bigger company, we translate that to corporate speak, right? We've got people that are leaders in certain parts of our company, or they're managers, and they're just practicing corporate speak. They're trying to, repeat the lines they ought to repeat, but it's not authentic. They're not able to articulate it in their own words, and their people recognize that. So, but those that really own it personally, it makes such a tremendous difference from a leadership standpoint. People read that. It's either real or it's not real. And why that's so important is that, I think that good people, good employees, they want to be engaged. They want to be passionate, but they need to follow a leader who's engaged and passionate. So you're not going to bring out the best in your best people if you are not leading from the heart and leading from a passionate perspective. But people want to be part of something that's valuable and important, especially young people these days. And that's something that, we notice in our organization is, particularly with young people, it's so important to them that they feel like they're part of something valuable. And if they're not, they move on much more easily than some of us who are a little older did 20 and 30 years ago. So they want to know what your values are. Understanding your values is really important. Again, more to younger generation than ever. And I think we all see this, but clearly we're in a slow growth phase. We have been, and I think, in the sense we have, is we're going to be for a long time. And we are. And when you talk about slow growth, one of the impacts that we feel in our organization that we all will see is prolonged low interest rates. We have spent a lot of time. It's funny, in the kind of post-crisis, we spent 5 years so focused on stress testing and tuning that up from a credit quality perspective. And I'll tell you what, in the last couple of years, the stress testing, if you will, that we spend a lot of time on is what happens in this protracted period of low interest rates and potentially negative interest rates, because it's extremely impactful on an economy, and most impactful obviously on a financial institution. So anyway, point being, we see a long period of low interest rates, and it's really because there's plenty of money in our system. You talk about M1, you talk about money supplies. There's plenty of money out there, but just there's not much velocity to it, not as much as there was, and so. So we see this prolonged period of low interest rates and slow growth, and that is also driven by demographics. I mean, at the end of the day, and you can see this around the world, particularly in Europe. You've seen it in Japan for many years, but you've got aging populations here and around the world, and particularly, I think, maybe most recently in some of the Western European countries like Germany, you've seen it. I mean, that's why rates are negative. They're just demographically, you've got to have growth in terms of how many people you've got generally to have real economic growth. So with no population growth, it's just difficult to grow your economy. The other thing is when you get older demographics, older populations, at the end of the day, the reality is they become savers. And so, those things, again, lead to slower economic growth. So, use the term awash in capital. And if you think about it, part of this is driven by, some of the slower growth demographically we talked about. But the other thing is we are creating tremendous efficiencies. And I mean efficient uses of capital, ultimately. And some of the efficiencies we're creating, there's a really good example somebody pointed out to me a couple months ago, but pull that phone out of your pocket. And actually that thing today, for whatever you paid for it, $500-600, it's a telephone, it's a TV, it's a computer, all in one. It's your clock. My kids, none of them own a watch. They're like, why would I? I've got a phone. So now it is all those things bundled into one. And that's just one example of, how we've created efficiency. I look around our company and we're focused on doing a lot of robotic process automation. And again, I mean, so we buy a few bots and all of a sudden, we can eliminate 50 people in processes. So that's all. It's not that is negative. I think we have to understand that as we become more and more efficient at these things we do, and we don't have significant growth demographically, that efficiency is going to lead to the fact that we've got more capital, frankly, than we need, and capital is trying to find a home, and I think we all see that. So. So anyway, I guess I would just sum that up by saying, the better efficiencies mean less capital required. Slower growth from demographic change means there's probably less capital required and slower economic growth. And so if that's what the world looks like, again, I don't think it's a big problem as long as we plan for that. And I think if there's a good, side to it, we may just feel less volatility than we've felt sometimes in the past. So, but anyway, that's one person's perspective, and love to hear threats to this. Who knows where the next downturn or what it's born of. It's not in the real estate world this time. If there's a stress point out there, it's really corporate debt and corporate leverage. Interestingly, and this is not a defensive comment, it's interesting, it's not in the banks. it's the non-banks, it's the hedge funds, the sponsored entities. I mean, that's where a lot of this debt is coming from. And again, it goes back to there's all this capital chasing something, and it chases debt through other vehicles now. Although I will say that if there's a threat that the banks are, or how the banks are a part of this threat maybe, is the debt they have to those hedge funds or sponsored entities. So basically leverage the leverage. Tim, I know you've seen that before, where banks are leveraging the leverage, and so you essentially are the leverage. But anyway, but and that probably is not a high stress point as long as rates stay low. But it's just another one of those things that if rates move, I think you're going to see some issues there. But and then Tim was mentioning this earlier. I know you guys spent a lot of time talking about, Ray Dalio's perspective, which I certainly appreciate. But I think, the other threat ultimately in the long run is China. It's a rapidly developing economy. I mean, we see that, their whole goal is just to be the dominant world economy. And I think really, it's funny when I talk to some people about it, like, yeah, so what? Well, the so what to me is, here's the real risk is that, and I was mentioning this to Tim the other day. I mean, we are the world reserve currency, the dollar. And, you can talk to various people, but there's, 25%-ish, maybe 30% of the value of our dollar is the fact that it's world reserve currency. Everybody's got to have them. And, what that translates to is our standard of living is, frankly, probably 25 to 35% above what it ought to be, frankly, just because we're that world reserve currency. I mean, the day nobody wants dollars anymore or doesn't have to have dollars to trade, we're going to feel pain internally. So I think there's something, very real to what's going on with China. And, interestingly, I don't know if anybody's read this book. I literally just got it and haven't cracked it open. But anybody heard of the book? It's called Ghost Fleet. It's by P.W. Singer. And it's basically as best so I've just read the synopsis, but it's about World War III, but it's not the way the World War III doesn't happen in the way we think about a traditional war. It's basically an economic and cyber war between the U.S. and China. So I'd be interested to read it just to see what that looks like. So it's funny. We did. Actually, I don't know if you remember talking about this, Tim, but I went back and looked at some work that was done years and years and years ago about housing markets. And there was this study called the Herengrat study. And it was literally, you were talking about the Dutch. It was a Dutch village. And I can't remember if it was the 1400s, 1500s, but it's hundreds of years ago, and looked at a upper middle income community that, was and remains, kind of upper middle income. And over time and what happened. And the reality is that, over hundreds and hundreds of years, the value of residential real estate changed by the value of inflation. That's it. And so there was like a very, very, very minor premium, maybe 0.5% growth beyond the rate of inflation. So you have these markets where residential real estate will increase dramatically, and then it'll always settle back down. And so use that as a baseline, and then understand that the majority of real estate in our country, when it's purchased, is purchased with a traditional mortgage. And when it's purchased with a traditional mortgage, there's people tend to generally borrow at or toward the max. And so what works as a really good rule of thumb in any market is if you look at the median income in a market, that the median home price ought to be running no more than 3 times the median income. And that over time, again, in our country, tends to tell you where real estate markets ought to settle. And again, now that's all about the median. It's not about an individual home or an individual subdivision, but median prices really can't exceed 3 times median income. Money, I think just, understand where banks are today, this low rate environment. And so what low rate environment means for a bank is that there's not as much margin in a loan. And margin needs to pay for the cost of the operation that you're running as a bank, and also needs to set something aside for a loan loss reserve. And so when you have this, protracted low rate environment and therefore very low margins, and that's why bank stocks are not worth a lot these days, at least those that are in the business of renting money, which we substantially are, and it's something we're trying to change in our company, because this gig of making your money renting money, that's I think, up for a long time. Again, just given this low rate environment. But that said, understand that there's just not much room for loss content in a bank's margin. And so banks are going to be more selective about credit. But now you've got the emergence of these fintechs, and they'll loan money, especially to small businesses left and right. Their rates tend to be, a good bit higher. That sustainability of that needs to be tested over, some kind of downturn to see if they can handle it. But banks want better credit. Okay, that's what's going to happen. And so I think one of the things that I say to businesses that are borrowing money is pay attention to your balance sheet. I think the focus tends to be more on the income statement, and I recognize why, but just understand when a bank is going to make a credit decision, and especially a credit decision based on needing to take less risk and more risk, they're going to focus on the balance sheet. So a good, strong balance sheet is key, and understand that. I think the other thing I would just say for as you think about, borrowing money is that because of this, again, protracted low rate environment, low margins, banks aren't making as much money on that part of renting money. Understand that there's other ways they make money. And so this is how you can become a more valuable or a better customer for a bank. And it's, just understand that it's not about loans only, and it's, the deposits are valuable, but, the other stuff is valuable. The merchant account, the mortgage, the wealth management business, all that stuff is valuable. So if you're really thinking about, who you're going to bank with, the more you can do with them these days, the more important it is, just because those ancillary, what we would consider ancillary pieces of business, are frankly the most valuable